So with this recent dip in the market, I thought it would be an interesting time to post two stocks that I actually really like and I'm looking to add to. But one of them I'm a little bit less likely to add to only because it's already my number one position. But if it continues to go down, I might just be forced to add to it even more. But the first stock that we're going to start off with is EA. Now, EA, I wouldn't say is a stock that I would be willing to put as my number one position. But I do see a future where EA could easily hit 190, 200. And I think it is a good stock for my portfolio to just have somewhere like in the middle or towards the bottom, just to kind of help diversify my portfolio. Now, so far, I only have a starter position in EA with 10 shares at around $14.40 of market value, and I am slightly down on it. Now, under that EA umbrella, they have various different studios and companies. One of them famously is BioWare. And if you guys don't know what BioWare is, they're responsible for Dragon Age, Mass Effect, Anthem, huge video game titles. They also own Respawn Entertainment, which is responsible for Apex Legends. They've also produced some other fairly successful video games like the Star Wars Jedi Survivor games. But basically my point is they own so many very successful companies, very successful video game titles, brands, etc. And if we look at the PE and forward PE, it looks fairly cheap. Now, I know in recent years their revenue has slowed down, but I don't expect that to stay where it is forever. I do believe that EA will find more ways to monetize their existing brands and, of course, continue coming out with new video games, new brands, new stories that will become future hits. So I think paying a 2027 forward PE of 15 is a pretty fair price for me. And as I've mentioned before, the revenue has slowed down a little bit, almost 4% year over year. But if we look at the past 3 years, they've consistently been able to do 8%. And of course, being a video game company, they're going to have insane gross profit margins. And I know technical analysis is not for everybody, but I do pay attention to everything instead of being very dogmatic and hyper-focused on one thing, because I like to see what all participants in the market are looking at. And of course, half the market is more concerned with fundamentals. The other half is more concerned with technicals and just noticing patterns. And so for EA, I've noticed a ton of consolidation. It has this huge resistance at 145, but as I've said before, I think it could easily break that and start shooting to 190. And if we look down a little bit closer in the monthly time frame, it looks like this recent pullback is finding some support. So again, around the 144, 145 support level. Now, of course, if there is a huge market crash, it could easily fall to 120. But I think starting a position for me now is a pretty good time. Now, one of the things fundamentally that I think could help push EA past that 150 level to help it start shooting to 180 is, as I said before, finding better ways to monetize their existing brands. Now, the brands that I showed you earlier are only a handful of things that EA owns. And I think in future years, EA will be able to find more ways of monetizing their IP and their existing content. Now, one of the ways that they could do that is by creating more movies and TV shows as they've done before. And yes, I know that their previous titles may not have been as successful, like their video games translating into movies and shows. It might not have gone as smoothly in the past. But with this recent trend of Hollywood taking old video games and old titles and converting them into movies and shows like The Last of Us, and I think this trend will continue and EA should be able to benefit off of that. Now, the next stock that I'm going to talk about is actually my number one position. And if you guys haven't seen my portfolio reveal video, you guys should go check that out to see exactly how much I have in each stock. But Robinhood, I think coming back below $20 is a very interesting opportunity for people that have been kind of avoiding it. I've noticed a lot of retail investors have been avoiding Robinhood and doubling and tripling down on SoFi and PayPal. And I understand if Robinhood in the past has left a bad taste in your mouth, but I don't think that it is well deserved now. I think Robinhood has worked very hard to try and win back retail investors. And I think they've they put in enough effort to win back my trust. And I think towards the peak when Robinhood was soaring like crazy, it was almost 50% of my portfolio. But after coming back down hard, it's slightly below 40%. But the reason why I'm comfortable with such a large part of my portfolio in Robinhood is because of how bullish I am on the company. So currently they're sitting at about a 27 PE, but a 2026 forward PE of about 26, 27. So basically the market is saying that there's going to be no multiple expansion at all. Like they're just going to hover around a 26 PE. And they're also trading at a price to book at around 2, with revenue growth year over year of 34%, even with all of the turmoil in the markets, all the scare, people talking about how bad the economy is. They're still growing revenue year over year at about 34%. And the past 3 years, it's been growing at a consistent 10%. And of course, gross profit margins are insane at around 85%, but it's not as good as Charles Schwab's yet. I think Schwab is around 90% somewhere. And just for comparison, I'm throwing up the numbers for Schwab, which is trading at around 3 price to book with negative revenue growth year over year and only a 3-year revenue growth rate of about 5%. So basically, the market is putting a slight premium on Charles Schwab, even though they have no growth compared to Robinhood and half the revenue growth of Robinhood if you're looking at the past 3 years. And currently, Robinhood is sitting at around a 16 billion market cap with only 5 billion of debt and a crazy 11 billion in cash. So almost their entire market cap is just sitting in cash. And of course, just for comparison, I'm throwing up Schwab's numbers as well. And they're sitting at around 115 billion. So 115 billion with 50 billion of cash and total debt of about 62 billion. So not a terrible balance sheet, but definitely not as good as Robinhood's. And I do think in future years, Robinhood will eventually get to the point where Charles Schwab is. So if we're looking at it market cap wise, that's almost a 10x.